Hey everybody, Kelly Weber with the Bergen Realty Team at Keller Williams here today with Sean Crotty from Crotty Insurance Agency in Paramus. Sean, thank you so much for meeting with me. How are you today?
Thank you for having me on, Kelly.
Oh my
I'm
gosh,
good.
it is
I'm good. I'm
it's
good.
a pleasure. Well, Sean and I we've done a lot of business together, and I think what you and your company have to offer, to get your name and information out there, everybody should be using you. So let's
Thank you. I
talk.
agree.
Yeah, I agree too. So let's talk about, the sexy stuff, insurance. Let's
Oh, yeah.
start with property and casualty. Tell me about it. How do you handle it? What do people need to know? What do they need to do?
So property and casualty is auto and home insurance, the simpler way to say it. Um, the property and casualty industry, it's a little bit difficult as you've seen. As your renewals come in, you're going to notice that your rates are constantly going up and they never stop. Usually, what I recommend for our clients is that you shop it around at least every 2 to 3 years. Using someone like an Allstate agent or someone that is tied to one company can be good for some reasons, but bad for another. I
Mhm.
prefer we act as brokers, so I can write for over 20 different carriers. So if you sent it to me, I would send it out to all of my carriers. Whichever one comes back the cheapest is what I would send over to you. And then we can wash, rinse, and repeat that every 2, 3 years to make sure that your rates stay appropriate.
Because the different companies do vary from company to company, obviously, but also year to year, things change.
hmm Yeah, they go through phases. Sometimes they're looking for coastal properties. Sometimes they're looking for young families with two cars. Sometimes they're looking for elderly drivers, and it constantly changes. So a company will be advertising 1 year for coastal properties. The next year, they won't be writing coastal properties because they already hit their mark and they hit their quota of how many coastal properties they want under their belt. And it becomes very confusing. So if you don't do it every day, it's just not something that you can navigate on your own.
Gotcha. And so you're talking coastal property. So I'm assuming you can write anywhere in New Jersey or do coverage anywhere.
Anywhere in New Jersey, pretty much anywhere in the continental United States, except for California, please don't send me to California. I'm
Yeah.
okay. Um, but yeah, Jersey Shore is good. Condos by the shore are still okay. I can find good carriers for those. It's the standalone homes that are a little bit more difficult. But also condo associations, like your
Okay.
master policy for if you're a condo building, if you're on a board or something, those prices are insane. I can also rework that, attempt to save you money. If I try to find you a better price and it comes out more expensive than your current price, obviously you just stay where you
Just
are.
stay where you
There's
are.
nothing to, yeah, there's no,
Harm,
I
no
mean, there's no
foul.
fee to charge. I'd be
Yeah.
happy to run it for free. It doesn't cost anything to check.
Perfect. Perfect. And same thing with auto insurance.
Auto insurance, yeah, it's the companies are becoming more difficult there too. You'll see your rates going up like crazy if you have accidents on it. Some carriers, if you have 2, 3 accidents, will just say they don't want to insure you anymore, and then you'll have to find a new carrier. It's anything you can do to keep a claim off your record
Mhm.
is advised. Like if you have $1,000 deductible and you have an incident where it's going to cost $1,200 to fix, pay for it yourself. Don't call the
Exactly.
insurance company. People call those claims in, and it while it doesn't show an immediate impact on your policy, that's going to stay on your record for 5 years. So if something else happens, now you have two incidents. So the one incident isn't a problem. It's once it becomes
It's
two,
the
three,
second.
four, five, and then you become uninsurable.
Well, welcome to New Jersey.
That's lovely here.
Exactly, exactly. All right, let's switch over a little bit here. Let's talk about life insurance. When should
Mhm.
someone consider getting life insurance?
So life insurance is can be purchased at any age. My 3-month-old has her policy. She's very
Wow.
excited about it. Um,
I
but
think that's
the
great. I
meantime,
think everybody should be doing that when you have kids.
it is fantastic. It's something that's good to do, and it's not something that's going to directly benefit her as long if she keeps paying the premiums. But my grandchildren are going to be the recipient of it, and I'm perfectly okay with that. I don't know if people see down the line that far, but that's something that I wanted to do and something I thought was important. So it's something I took care of immediately. But for most people, the most appropriate time to buy life insurance is when you are a first-time home buyer,
Okay.
or you are a brand new family with a newborn, or you just got married. So for first-time home buyers, typically you take out a 30-year mortgage, and usually you spend all the money you have on getting that mortgage and buying the house. but you do need to get a 30-year term policy. Well, especially for dual income households, because if
Mhm.
something happens to either spouse and the surviving spouse can't afford to pay the mortgage with their own salary, they're going to have to sell the house. They're going to have to move. They're going to have to completely uproot their life. And after losing a loved one, it's the last thing that you
You want
want
to
to
do.
consider doing. Um, Also, because it's so cheap, if you get a $500,000 30-year term policy for like a 32-year-old, is like $40 a month, maybe less. Like
So
it's
worth
not,
it.
and the price stays level for 30 years. So while you have this mortgage, you're covered for the next 30 years. Um, Also, when something that comes along with the term policy is the ability to convert it to a permanent policy later on down the line. So maybe they're not ready for a permanent policy yet, but it locks in your health rating class while you're young and healthy.
Oh, that's
So
great.
if a 32-year-old in this example were to have a 30-year term policy and say when they were 50 years old, they developed any sort of severe, they cancer, diabetes, anything that would
Mhm.
make them insurable to get a policy in the future, the company will give you a permanent policy at your health rating that you got back when you were
Originally
32
signed
years
up
old.
with. That's amazing.
That's one of the most important things because it does become a whole issue as if you start developing things. And when you're young and healthy, you feel like you're going to live forever, so nobody cares. But it's
Right.
something that's important to lock up.
So let me just make sure I understand this. So they lock in, let's just say it's $40 a month for a 32-year-old. When they're 50 years old, they're still paying $40 a month
On their term policy,
on their
yes.
term. That's what I meant on
The
their
term
term
policy, the
policy.
price doesn't change for 30 years. But if you were to convert it to a permanent
Well,
policy,
that's
then it's more
different.
expensive,
Yeah.
obviously. Yeah.
But let's look at that. When you're 30 years old, I mean, 30 whatever years old, and you look at 50 years old, obviously you have to imagine they're now making that much more money. So it may
Mhm.
be a struggle at first, but think 10, 20 years down the road, you'd be kicking yourself for not doing it.
Absolutely. And for $40 a month, it's really to make sure that your family's protected, especially if you have a young child. Do you really want them to have to sell the house and move?
No,
Like, no,
of
you want
course
everything
not.
to stay the same, everything as comfortable as possible. But for dual income households, it's important when if someone's the primary breadwinner, obviously, I hope they have it because, what's the surviving spouse going
Right.
to do? But also for moms at home with the baby, daycare is expensive. If something were to happen to mom, how are you going to afford to pay for the daycare? Who's going to take care of the child while
Right.
you're working full time? So it's extremely difficult. It's important for everyone to have.
I was a stay-at-home mom when my kids were younger, and it was more money to insure me for that reason way back
Hmm.
then because of daycare and have somebody come in to, take care of the household. So I was worth more dead than I was alive at that point. But people don't think about that. If you have a stay-at-home mom and you have, your husband out working and God forbid something happens to the mom and it's so important to have coverage on both people. So that's great. So obviously we covered, why it's good to have term, but now why would you go over to a permanent policy?
So a permanent policy is something. Well, the term obviously can't last forever.
Yeah.
So when the term runs out, that's usually the time when everyone's like, okay, now it's time to think about getting a permanent
Permanent.
policy. But at that point, now you're in your mid 50s or 60s, depending on when you purchase the policy, and now it's extremely expensive.
Yeah.
Now you're going to be paying a couple $100 a month. While if you get it when you're younger, if you can afford to do it, and that's the difficult part about it, but if you can get it when you're in your 30s or even 40s, early 50s, but anything after that, it's going to be expensive, but you can get it for a very reasonable rate. A lot of times you don't need $1 million of permanent coverage. You just need maybe 100,000 of permanent or 200,000 of
Mhm.
permanent. So a lot of time people will stack them. So they'll get like maybe a $500,000 term policy and they'll get a $100,000 permanent
Permanent.
policy. So you can do both separate policies, but it makes sure that when the term policy runs out, that you won't be left with nothing.
That's great. That's awesome. And
Mhm.
can you keep adding? So if you have $100,000 of permanent, can you come back in 5 years and say, I want to up it to 250 or 300?
You absolutely can, but anytime you want more insurance, you're going to have to take a medical exam.
Okay.
So as long as your health is good, then it's no problem. But if you develop some sort of an illness, then it's going to impact the rate. It's going to be a separate policy. You can't add on to the same policy.
Okay, so what would you say is the best age for someone to consider getting a permanent policy?
A permanent policy, the best age would be when you're as young as possible.
Young as
So
possible.
immediately, I would recommend getting a permanent policy because you can get it for under $100 a month. Um, but the latest I would wait is your 50s. Your 60s, you can still do it. It's just expensive.
Right.
Once you hit 70, it's just not financially possible unless you do like a survivorship policy, which is like a second to die policy, which is usually it's used for more estate planning. So
Okay.
you get the policy on a husband and a wife, but it doesn't pay out until the second one passes away.
Oh, okay,
But
I got
because
you.
of
All
that,
right.
the price is significantly cheaper because if the first one passes away, no death benefit is payable. It's only when both of them are deceased. But yeah, mostly estate planning for that.
So I'm going to ask this question because it was something that, I mean, I'm in my mid to late 50s, but when I had my kids, our agent at the time, which, my kids are almost 30, asked me about long-term care. You should consider it for your parents. You should start considering it for you. How do those policies work? I think it's
Uh,
important
so
today.
yeah, long-term care policies get expensive. So
Yeah,
there's two ways to do it. I sell traditional long-term care policies as well.
good.
They're becoming increasingly less popular. Um, so what people are doing now is they're kind of blending the policies. So long-term care policies over the years, the prices, while they were promised to be low, you see they start to get higher as you get older. And once you start going into your 80s, you're going to get a letter. They're going to say, hey, you're either going to have to pay us more money or we're going to start decreasing your death benefit for the same amount they are, not death benefits, increasing your coverage, decreasing your coverage. That's not very comfortable. And it gets to a point where they price you out of the product and you have to give it up because you can't afford it. You're older, you're on a fixed income,
Right.
and some people can't afford to keep the policy that they've been paying for 20, 25 years. Um, so with a life insurance policy, they blend it in. So your death benefit would be the pot of money. So like if you were to
Okay.
have a $500,000 permanent policy, you can't do this on a term policy, but a $500,000 permanent policy, you can start drawing off the death benefit once you go on claim for two of your six ADLs or activities of daily living. Once you can't perform them as determined by your doctor, you can start using your death benefit while you're alive, which
Oh,
is
wait.
not something that is typical. Usually it's just for the beneficiaries, but now you can start using it. Um, if you had a $500,000 policy, you could pull $10,000 a month from the death benefit
Wow.
until you've exhausted it. But remember, you only have 500,000. So
Right.
if you use 250,000 of it and then you pass away, your beneficiaries now only get
Right.
250,000.
But
But yeah,
that money can be used if somebody goes into like an assisted living or a long-term care facility.
it can be, but the reason why I like it better through the life insurance policy is that you don't have to pay a licensed nurse this money to take care of you. You can pay a family member, you can pay your kids, you can pay a neighbor. If someone needs to take time off work, now you have the funds to pay them. Prudential sends you the money. They don't care what you do with it. A lot of times with a long-term care policy, they will only reimburse you for necessary medical expenses.
Right.
So you have to fill out a form. It's a huge pain. But so this one is a little bit easier. But Prudential, really all they're doing from their perspective is expressing your death benefit because you're on claim, you're getting a little sick. They know they're going to have to pay you out in 4 or 5 years, most likely, anyways.
Hmm.
So, in order to sell product and because it's good for the consumer, they do this, and now you have access to your money. But yeah, you can spend it on whatever you'd like.
That's great. Listen, I'm going to have you back on because I do, as you know, a lot with, the seniors. And I think that's a great thing to talk about with our, younger folks for what they can
Mhm.
do down the road. Because honestly, as we're now taking care of our parents. And when I
Yes,
say
and it's very
we,
expensive.
me, not you, you're
Mhm.
younger, a lot younger than me. But again, that's great to know. I'd like to dig deeper into that on another call. But Sean, I have
Mhm.
to tell you, you have been amazing. I Everybody should be using you, speaking to you. for all types of insurance. And I look forward to having you back again. We're going to put your contact information below in this video, and people will put a link to your company. And I can't thank you enough today for spending time with me. I learned so much, and I thought I knew a lot.
Well, happy I could help.
So thank you, thank you, thank you. And we will talk soon. I'm gonna reach back out to you, and we're gonna talk about that policy where people can pull money out of it on our
Absolutely.
next interview. Thank you so much.
Cool. All right. Have a happy holiday.
Thanks. Bye bye.